Welcome to The Deep Dive, the show that cuts through the noise and gets you straight to the essential insights from the latest earnings calls. Today, we're dissecting Autodesk's second quarter and full fiscal year 2026 results.
That's right.
If you've been wondering what's next for this design software giant, or, if they've finally shed some long-standing concerns, you're in for a treat.
Yeah, absolutely.
We've taken a stack of sources, the earnings call itself, investor notes, expert analysis, and we're ready to unearth the most important nuggets for you.
Exactly. Our mission here is to break down these, frankly, impressive numbers, pinpoint the strategic shifts, and really explore what this all means for Autodesk's future trajectory.
Okay.
Because this quarter was, well, genuinely pivotal. Some significant developments, and the market certainly reacted with enthusiasm. Suggests a potential turning point.
Right, a turning point. So let's start with that big picture, the results snapshot that got everyone talking. Autodesk delivered a remarkably strong second quarter. Significantly exceeding market expectations across pretty much all key financial metrics.
Pretty much, yeah.
This stellar performance has truly fueled a highly positive outlook and a robust response from investors. What was the headline here, if you had to pick just one?
The headline for me is a clear message of strong execution finally overshadowing, well, past distractions.
Okay.
The company reported impressive beats on both GAAP and non-GAAP earnings per share. Both, coupled with robust revenue growth that outpaced consensus. But maybe most tellingly, billings saw a substantial, I didn't even say exceptional surge.
Billings, right.
Operating margins expanded, free cash flow generation was a real standout performer.
Okay.
And these strong results, they gave management the confidence to raise their full year guidance for fiscal 2026.
Which is always a very strong signal.
Always a strong signal of an underlying business health. Exactly.
Okay, that's the high-level view. Now, let's really unpack those core numbers, because the details here, well, they tell an even richer story.
Let's do it.
When we talk about earnings per share, Autodesk reported GAAP EPS of $1.46. That comfortably beat consensus estimates, which were kind of in the $1.39 to $1.44 range. Right. But the non-GAAP EPS came in even stronger at $2.52, well above the $2.44 to $2.50 consensus. For those listening, what's the significance of seeing both GAAP and non-GAAP beat so handily like that?
Yeah, that's a crucial distinction, especially for a software company like Autodesk. Look, GAAP, generally accepted accounting principles, includes all the standard stuff, even non-cash or one-time charges.
Right.
Non-GAAP, on the other hand, often strips out things like stock-based comp or amortization of acquired intangibles.
Gets you closer to operations?
Exactly. Gives you a clearer picture of the company's operational performance. So when both figures beat expectations by a significant margin like this, it tells investors the company isn't just financially healthy, but its core business operations are performing exceptionally well. Driving profitability, efficiency. It's not just a lucky quarter. It suggests, fundamental strength.
And that strength wasn't just on the bottom line either. Revenue hit $1.763 billion.
Yep.
Surpassing the $1.72 billion consensus. That's a healthy 17% year-over-year increase, or 18% in constant currency, showing consistent growth.
Solid growth.
But you mentioned billings earlier, and that's where things get really interesting, you said.
Indeed. Billings showed an exceptional 36% year-over-year jump, hitting $1.678 billion.
36%? Wow.
Yeah. For a software as a service company, billings are just a crucial forward-looking indicator. Think of it like a builder receiving a large upfront payment for future work.
Okay.
It's essentially the total value of invoices sent out during the period, represents both recognized revenue and deferred revenue for future periods.
Right.
So this massive increase signals very robust customer demand, especially for their subscription products, and it provides a strong runway for future revenue recognition.
Makes sense. Profitability metrics also showed strong expansion, which is, fundamental for long-term health and investor confidence.
Yeah, absolutely key.
GAAP operating margin increased to 25%, up a solid 200 basis points. That's a 2% improvement.
Yeah, indicating stronger core operational efficiency.
And non-GAAP operating margin reached 39%, up 100 basis points. But free cash flow, that was truly a showstopper.
It really was.
Growing a staggering 122% year over year to $451 million. Cash flow from operations, CFO, also up significantly at $460 million, a 117% increase. Why is this free cash flow figure so impressive? Why does it matter so much?
Well, look, free cash flow is arguably one of the most important metrics.
True.
It represents the cash left over after you account for operating expenses and capital expenditures. It's the actual cash the company generates.
Right, what they can actually use.
Exactly. Money for debt repayment, dividends, share buybacks, strategic investments, basically. It's the fuel for growth and shareholder returns.
Oh.
A 122% year-over-year jump. That indicates not just efficient operations, but also strong collections, maybe less need for immediate capital spending. It speaks volumes about financial discipline and just a robust business model.
A clear sign of financial strength.
Definitely.
And speaking of future revenue, financial visibility, the remaining performance obligations, RPO, that also grew a robust 24% to $7.297 billion.
Strong number.
And what's more, the current RPO that's the bit expected as revenue in the next 12 months was up 20% to $4.677 billion. How should we interpret these RPO numbers?
So RPO is basically Autodesk's backlog, committed customer contracts, revenue yet to be recognized.
Like a guaranteed income stream waiting?
Pretty much, yeah. Think of it that way. For software companies, this is critical because it gives you substantial visibility into future earnings. The fact that both total RPO and, crucially, current RPO are growing so strongly tells us Autodesk has a very healthy pipeline of contracted revenue. It offers a predictable, stable foundation for their financial outlook. It de-risks future quarters quite significantly.
So we've seen strong financials across the board. Now let's zoom in on where this growth is actually coming from.
Good idea.
Looking at segment performance, architecture, engineering, construction, and operations, or AECO, that was a primary growth engine. Clearly. Increasing 23% to $878 million. AutoCAD and AutoCAD LT, their flagships, grew 13% to $440 million.
Still solid.
Manufacturing also rose a healthy 13% to $334 million, and media and entertainment saw a 4% increase to $80 million. What's the story behind AECO's outperformance there?
Well, that AECO segment's strong 23% growth isn't just a number. It signals really robust demand driven by these persistent secular tailwinds.
Secular tailwinds.
Yes, CFO Janesh Moorjani specifically highlighted strength driven by global investments in things like data centers, infrastructure, and industrial buildings.
Oh, okay. Big projects.
Exactly. Massive multi-year projects requiring sophisticated design and construction software. This demand provides a really resilient foundation for Autodesk. It effectively offsets any softness they might see in, say, other commercial construction areas. And management noted consistent momentum here, no deceleration. That's powerful.
Sustainable growth indicator.
For sure.
And it wasn't just about the numbers. Management also shed some light on strategic priorities. What did CEO Andrew Anagnost highlight as key drivers, especially when it comes to AI?
Right. The AI piece is fascinating here. Anagnost really emphasized the company's strategic focus on industry-specific foundation models and industry-leading AI tools.
Industry-specific. Okay.
Yeah. He highlighted how Autodesk is leveraging its platform and industry cloud go-to-market strategy to scale AI across their entire ecosystem. This isn't just generic AI. It's about deeply embedding AI into the specific workflows of architects, engineers, designers.
Makes sense.
For instance, he pointed to their AI-powered sketch auto constraint feature in Fusion. Apparently, it's got over a 60% acceptance rate and automates 90% of constraints for commercial users.
90%. That's huge.
That's a tangible productivity gain, right? Not just a cool feature, makes their software indispensable.
Absolutely.
And they also noted the upcoming Autodesk Assistant as an area of excitement driving immediate productivity through prompt-driven workflows. Sounds like a kind of co-pilot for designers.
Interesting. A clear differentiation then. So with all these impressive results, strategic insights, management clearly felt confident about the future.
You'd think so, yeah.
Providing optimistic guidance for the upcoming quarter and the full year. What did that updated guidance look like?
Okay, so for Q3 fiscal 26, revenue projected between $1.80 billion and $1.81 billion. GAAP EPS between $1.34 and $1.42. Non-GAAP EPS between $2.38 and $2.51.
Pretty tight ranges.
Yeah, but the full fiscal year 26 guidance was raised significantly across the board. Revenue now expected between $7.025 billion and $7.075 billion.
Big jump.
Non-GAAP EPS to $9.80, $9.98. Free cash flow in the range of $2.27 billion to $2.275 billion. And the non-GAAP operating margin now expected around 37% or maybe 40% on an underlying basis. These raised targets really underscore their confidence in operational momentum and the underlying demand.
Okay, now here's where we get to what many investors consider the biggest turning point for Autodesk this quarter.
Ah, yes, the overhang.
Exactly. A crucial development that truly removed a significant cloud hanging over the company.
Mm-hmm.
The resolution of those lingering regulatory concerns.
Mm-hmm.
Both the SEC and the U.S. Attorney's Office investigations related to free cash flow and non-GAAP margin practices were closed in August 2025. How significant was this? What kind of impact did this overhang have?
Oh, this cannot be overstated, really. The resolution removes a major overhang that's been a source of investor skepticism, uncertainty for quite some time.
The accounting noise.
Exactly. It was accounting noise questions around how they reported certain financial metrics, particularly free cash flow, non-GAAP margins. Now, while it didn't necessarily imply wrongdoing,
Right.
the mere existence of these investigations created a perceived risk around reporting quality. With these closed, it's like a huge weight has been lifted. Lowers risk around financial reporting, frees up management focus from legal stuff to core business ops, cost discipline, cloud transition.
Back to business.
Back to business.
Yeah.
And it undoubtedly contributed significantly to the market's positive re-rating of the stock. It signals that shift from accounting scrutiny narrative to one of operational execution.
That makes total sense. And building on that renewed clarity, the company also laid out an ambitious long-term non-GAAP operating margin target. 41% by fiscal year 2029, or approximately 45% on an underlying basis.
Yeah, that's a very telling long-term target.
What drives that kind of margin expansion? How does it connect to their broader strategy?
Well, this expansion is primarily driven by projected sales and marketing efficiency improvements and just inherent operating leverage.
Okay.
Think of it this way. As a software company scales, its fixed costs don't grow as fast as revenue, right? Leads to better profitability.
Right, leverage.
Exactly. And the new transaction model, NTM, which they've been implementing, that plays a big role here too.
How so?
The strength in Autodesk Store activity increased direct engagement with customers, particularly those maybe previously served by lower-tier partners. It demonstrates massive efficiency improvement. Allows Autodesk to capture more value directly, gather richer customer data. That, in turn, fuels their ability to automate cross-selling, upselling, self-service capabilities.
So it's more than just billing.
Oh, yeah, it's a strategic shift, enhances efficiency and customer insight. Plus, they raised share buyback targets for fiscal 26 by $100 million.
Showing commitment to returns.
Yep, now between roughly $1.2 billion and $1.3 billion. A clear commitment to shareholder returns.
So if we pull all these threads together, the immediate market reaction, and how does Autodesk stack up now in the broader investor context?
Well, the immediate reaction, that double-digit jump in after-hours trading, clearly signals a positive re-rating of the narrative. It really is a shift from accounting noise to execution. And remember, this performance comes after a period where the company had slightly underperformed the broader software sector.
So this could be that turning point.
Could indeed be a significant turning point. Renewed investor confidence, the market's appreciating their specialized approach.
You mentioned specialization earlier. It's fascinating how they're strategically differentiating in the, let's face it, crowded AI space.
Very crowded.
CEO Anagnost emphasizing industry-specific foundation models and AI-assisted geometry and design reasoning. How does this set them apart from more generic horizontal suites? What does it mean competitively?
Yeah, this is a crucial strategic differentiator. Instead of building generic AI tools that do many things, sort of superficially,
All right.
Autodesk is focusing on AIs specifically trained on vast data sets of architectural, engineering, manufacturing designs. Imagine an AI trained on thousands of architectural blueprints.
Okay.
Able to predict design elements, identify structural issues with a precision a general AI just couldn't dream of.
Deep domain knowledge.
Exactly. This specialized approach, focusing on spatial and physical reasoning with deep industry-specific knowledge, creates a new IP moat around their offerings.
An IP moat. Interesting.
It means their AI tools aren't just smart, they're contextually intelligent for their core users. It makes them incredibly difficult for broader horizontal software providers to replicate.
Sticky.
Very sticky, very powerful, enhances their competitive advantage significantly.
And that robust growth in AECO, fueled by those secular tailwinds, data centers, infrastructure, industrial buildings, provides that resilient demand foundation. Can we delve a bit deeper into those tailwinds? How sustainable are they? How do they specifically benefit Autodesk?
Look, these aren't fleeting trends. They're foundational, long-term global shifts.
Right.
Digital transformation everywhere relies on robust infrastructure, more data centers needed worldwide, government initiatives globally pouring trillions into upgrading aging infrastructure, roads, bridges, energy grids.
It's huge investments.
Huge. Industrial buildings, too, becoming more complex, automated, requiring cutting-edge design. Autodesk software, it's the foundational toolset for designing, building, operating these critical assets. These are multi-decade investment cycles. They provide incredibly resilient, predictable demand, a powerful buffer against any cyclical softness elsewhere. Management's confident these tailwinds will drive consistent momentum for years.
Got it. Looking ahead then, what are the key catalysts for the stock that investors should be watching closely?
Okay, several important catalysts on the horizon. First, obviously, the upcoming Q3 earnings print. Will this strong momentum continue? That's the question.
Always is.
Second, Autodesk University in September and their Investor Day on October 7th. Those are critical.
Why? Critical.
Because management explicitly said they'll share more details on their industry-leading AI tools and foundation models at those events.
Ah, the AI updates.
Exactly. These updates could further solidify their AI narrative and competitive differentiation. And finally, just the continued macro tailwinds from infrastructure and data center buildouts. Those remain key drivers.
So for you, the investor.
For you, the investor, it's crucial to closely monitor that RPO trajectory and AECO growth durability. Those are your leading indicators for sustained performance. Any positive surprises there could further fuel the stock.
All right, time for our seasoned investors in the room. Let's talk some aggressive yet calculated plays here.
Let's get into it.
Given Autodesk's strong Q2 print, robust guidance, that significant overhang removal, the bullish sentiment is palpable.
Definitely.
But how do we truly capitalize on this momentum, especially with the AI narrative gaining serious traction, maybe entering a new phase of market recognition?
Okay, here's a thought. Something a bit edgy, perhaps. A long straddle.
A straddle, okay.
But not just any straddle. We're looking at a long-dated, out-of-the-money straddle on ADSK options, specifically targeting the post-Autodesk University and Investor Day timeframe.
Long-dated OTM targeting those events.
Why? Because management has explicitly said they'll be sharing more industry-leading AI tools and foundation models then. We've seen how significant AI announcements can trigger explosive stock moves. The implied volatility post-earnings, that's already been realized, it's priced in. But we anticipate a new surge of interest, potential volatility around these strategic AI updates. That could lead to a substantial move either direction benefiting our straddle.
Okay, long volatility around the AI news. Now for the truly outrageous part you mentioned. To amplify this.
Right, the amplifier. We're combining this with a short position in a horizontal CAD software provider, one that demonstrably lacks Autodesk's deep industry-specific foundation models and multi-industry cloud ecosystem.
Shorting a competitor.
Okay. The CEO's clear differentiation that spatial and physical reasoning with deep industry-specific knowledge against horizontal suites, that isn't just marketing talk. It suggests a widening competitive moat.
The moat again.
Exactly. If Autodesk truly delivers on its AI promises at AU and Investor Day, the market will likely re-rate them and potentially punish horizontal players who might face increasing skepticism about their long-term position in an AI-dominated design landscape.
So it's a pairs trade, essentially.
Kind of. It's not just a bet on Autodesk's success. It's a bet on the specialization of AI and engineering software. And the capital released from that short could further fund the long-dated ADSK straddle.
Amplifying potential return.
Amplifying potential returns on a successful AI rollout. Creates a sort of quasi-arbitrage on the AI narrative's impact across the sector. It's certainly high conviction, high risk.
Definitely high risk.
But one with potentially explosive upside if that AI story unfolds as predicted.
Okay, definitely an outrageous but plausible idea.
Yeah.
Let's recap the core story then. Autodesk delivered an exceptional second quarter, significantly beating expectations, raising its full-year outlook. Strong, resilient growth, particularly in AECO, impressive free cash flow generation, and that long-awaited resolution of regulatory investigations has injected renewed confidence.
Absolutely. The company's strategic focus on industry-specific AI, coupled with operational efficiencies from the new transaction model, clear long-term margin targets. It positions them strongly for sustained growth and value creation.
Right.
It's a narrative that really speaks to both innovation and disciplined execution. Signals a potential new chapter for Autodesk.
And as a final thought for you to mull over, consider how Autodesk's strategic bet on specialized AI might not just redefine their own market, but potentially force a reevaluation of how all enterprise software companies approach AI integration. Is deep vertical integration the future? Or will generalist AI tools ultimately prevail? That's a big question worth thinking about.
Good question.
As always, this information is for educational purposes only. It should not be considered financial advice.
Please don't.
We encourage all our listeners to conduct their own thorough due diligence. Thank you for tuning in to The Deep Dive.
Thanks, everyone.
And we look forward to hearing your insights on this earnings report.